Hello, I'm Carolyn Herbert from the Finance News Network, and joining me from MLC is Portfolio Specialist John Owen. John, welcome to FNN.
Thank you very much.
John, for those who aren't familiar with the Inflation Plus portfolios, how are the strategies constructed and what is the fund's focus?
We offer 3 Inflation Plus portfolios to our investors. A conservative portfolio, a moderate portfolio, and an assertive portfolio. The 3 portfolios have different time periods of investment. The assertive portfolio, we're investing longer term for 7 years, the moderate portfolio 5 years, and the conservative portfolio 3 years. The common linkage with these 3 portfolios, though, is that each of them is designed to outperform the rate of inflation to varying degrees. So the assertive portfolio measures success by outperforming inflation by 6% per annum over those rolling 7-year periods. The moderate portfolio is aiming to achieve a return above inflation of 5% per annum, and the conservative portfolio 3.5% per annum. Okay, so the focus is very much achieving an explicit return objective, in this case outperforming the rate of inflation. What these portfolios are not focused on, though, is outperforming our peers, peer funds in the industry, or even market-related performance benchmarks.
And how is this investment approach different to other fund managers?
It differs in the way that the funds are managed, and the way we manage these funds is to adopt a very flexible and less constrained manner in the way we adjust these portfolios through time. So being unconstrained and being flexible in the way we adjust these portfolios through time, we think is very important because it enables us to better manage risk as risk arises in markets, and also enables us to capture returns when we see the return potential that is there. So the asset allocation also of these funds, therefore, extends way beyond traditional asset classes like shares and bonds, which you will find in most diversified manager portfolios. So in these portfolios, with a very strong risk management focus in mind and also going for return, we do have a fairly significant allocation to what we call alternative assets and managers who manage money in a very different way, or alternative asset classes like insurance-related investments or private equity. From our perspective, the more levers we have to pull, the better we think we are able to manage risk through time and hopefully achieve the real return objectives that these funds are designed to achieve. So that is why the asset allocation and the composition of these funds will typically look very different to traditional or standalone multi-manager, multi-asset funds that you see in the performance league tables.
And continuing on with risk, how does risk play into the positioning of the portfolio?
Well, the management of risk in these portfolios is a very important focus. And what we mean by risk management is minimising the impact of adverse market situations on the returns of the investors. And to manage risk, we do a lot of what we call scenario analysis. We're asking ourselves, where are we today? And where are we heading in terms of the market and economic environment? And with those insights in mind, what should we be doing with the portfolios today to either protect our investors if we see adverse circumstances ahead, or to position the portfolios to exploit good return opportunities if we think they are there. But risk management is a very explicit focus of these funds. That is why, for instance, in the conservative portfolio, we have had over 30% allocated to cash in the last couple of years.
And John, what role can Inflation Plus funds play in investment portfolios?
Well, because of the very strong risk management focus of these funds, we find they are very popular with people who are either retired or people who are close to retirement, and it's those investors who have limited tolerance of a very large negative return because they have limited ability to make up the lost capital. Time is basically not on their side. So you could also argue, though, that apart from those investors, even someone with 20 or 30 years before they retire, the big risk they face is that the money they are contributing to superannuation through their life, of inflation will erode the future purchasing power of that money that they're going to rely on when they retire. So these portfolios, not just for retired or pre-retired investors who have a very low risk tolerance, but you could mount a very convincing argument that even wealth accumulators through most of their investing life should also have these portfolios in their strategy.
And finally, John, market volatility is very topical at the moment, especially given the start we've had to 2016. How have the funds performed against this backdrop?
You're right, the start to the new calendar year has been particularly volatile, and even the last few months, and we're actually very pleased with the performance track record of the funds, not just in the short term, but the long term as well. So in the year to the end of December, the assertive portfolio achieved a return of 6.5% for the year. That's pretty good in a year of fairly extreme twists and turns in the markets. Over the long term, over the 7-year period, the fund has delivered 9.9% per annum, after fees and tax, I might add, in that period of investment. So especially over the long term, the fund has achieved its after inflation performance target with a very high degree of consistency.
John Owen, thanks for the update from MLC Inflation Plus.
Thank you.